Greetings, salutations, salutations, however you say it in your neck of the woods. I'd like to welcome you to another episode of Le Art of Reading Price Action. Again, welcome to another episode of the Art of Reading Price Action. And in this episode of Le Art of Reading Price Action, we will be discussing the order flow. Yes, the infamous institutional order flow. Before we get started, I'd like to introduce myself for those who may not know who I am. My name is Timothy Lee Rogers Sr., aka Aranya Grande. That's Big Spider for those that don't hablo Espanol. And I get on Algo's internet and I share my thoughts on how these whole ICT concepts work. Now, for those that's been asking about how to join the mentorship, again, there's a join button here on the tube, and the mentorship is $24.99 a month. Well, Tim, what's the $24.99 a month for if you put the videos up here on internet for free? Well, the $24.99 gets you a weekly homework review with myself where we go over any questions you have pertaining to the homework. You get access to 3 monthly Q&As. One is dedicated to the mentees. That's the second Sunday. But since the mentees is the highest tier, you get access to the first Sunday Q&A with the platinum members and the gold members. And you get access to the third Sunday Q&A with the platinum members because the mentorship is the highest tier. So get access to 3 monthly Q&As, a Wednesday night homework review, and all of them is at 7 p.m. 7 p.m. on Wednesday night for the homework review, 7 p.m. on Sundays for the Q&As. Now, and random pop-ups. You just get random pop-ups. They say I do a lot of pop-ups. They say they enjoy the pop-ups, but that's what you get for the $24.99 per month. And without further ado, let us get into Le Art of Reading Price Action, the order flow. Put your attention over there. Not on me, put it over there. Right over there. Where the little bouncing ball is over here. Put your attention right over there. Now, Le order flow. When it comes to institutional order flow, all right, the algorithm is seeking the institutional liquidity, and this liquidity can easily be found on the monthly and the weekly time frame charts. If you study the monthly and the weekly time frame charts, you would learn to see where the large fund liquidity is resting because the algorithm tips its hand at what it's doing. And with all the other teachings you've learned thus far, you understand the different ways the algorithm tips its hands. Remember, stacks on stacks on stacks on stacks, blocks on blocks on blocks on blocks, right? But the major shifts, they like jump out at you. They jump out at you on the higher time frames in hindsight. So what you want to do, you want to go back and look at the charts, right, in hindsight, and let the obvious price moves just jump out at you, right? And then you'll start to train your brain and train your eye to think in terms of the market efficiency paradigm. Remember the whole thing where everybody in the big circle, everybody in that big circle over there, they are the liquidity for everybody in that little circle over there, right? You start to think like the algorithm, right? And when you start to think like the algorithm, you look at the chart and you say, where is the maximum amount of liquidity? Where is the imbalance, right? Where is the inefficient, not just the imbalance, where is the inefficiency in price? You start to train your mind to think like the algorithm, think in terms of the market efficiency paradigm. And when you're looking at the monthly chart, starting at the month, any chart really, but starting at the monthly chart, then you start to focus in and see the areas of maximum liquidity and inefficiencies. You start to see it, right? What you want to do, you want to start by just looking at what price has done. Follow the order flow. You see price consolidated here, and then price sold down, right? Price went back up into that range. Price sold down. Price went back up into that range. Price sold down. Price went back up. So what is the algorithm doing? The algorithm is coming down to a type of external liquidity from this range, from that low to that high, right? Price come down to external liquidity, move back into the range to internal liquidity, comes back down to external liquidity, moves back into the range, internal, external, and it's moving to the maximum amount of liquidity and inefficiencies. It's seeking liquidity and balance, right? Now, on the higher time frames, we're talking about the monthly and the weekly. The bulk of the volume is in the bodies. You always hear the saying, bodies tell the story, wicks do the damage, right? So as price is moving on the monthly time frame, okay, when price is up here, if price wants to go higher, okay, the bulk of the liquidity would be above these bodies here, okay? But price has come up and taken out buy side over here already, and it's left a buy side inefficiency from this low to that high, right? It's only offered buy side. So when the algorithm gets here, right, it has come up and taken buy side liquidity. So it has already found liquidity. Now it's going to seek balance. Where's the inefficiency? Where's the imbalance? We have a buy side imbalance here. So price comes back down and fills in, offering sell side delivery, filling in the buy side imbalance. Now, when it gets down here, okay, it's filling in the imbalance. Where's the liquidity? Right? On the higher, the liquidity is over here. But on the high, yes, we did get below the wicks here. But on the higher time frames, the bodies tell the story and the wicks do the damage. So realistically, all the algorithm has to do is get below the bodies of these candles, because the bulk of the volume for this move up here is below these bodies. So, and if you look at these bodies on these candles over here, they're respecting the bodies of these candles, because the bodies tell the story and the wicks do the damage. Now that we've reached the liquidity over here, where's the imbalance? We have a sell side imbalance coming down here. So price moves back up, right? And it eventually gets all the way back up to where? The SIBI all the way at the top, but it also gets into the wick of this bearish order block on the monthly time frame, right? What's the order block's job? To block price. So price traded back to a monthly order block, right? Stopped at the order block after trading back up into the inefficiency, and then it trades back down to where? The maximum liquidity. Where's the maximum amount of liquidity? Below these candles here. Yes, below the lows, right? All retail traders will have their lows below these wicks. Why? Because this is now support, okay? But on the institutional level, all it needs to do is poke below the bodies of these candles, right? And then if we look here, where did it stop? If we look to the left, everything you want to know is always to the left. Move over here. It stopped where? At a bullish order block, Right over here, you have a bullish order block coupled with a propulsion block. That's a type of order block. You got your consolidation. Move away. The order block is found right at or near equilibrium of the consolidation. So you have an order block that's bouncing off of another order block. That's your propulsion block right there. Boom. Right back into the bullish order block, propulsion block, and then move where? Back into the range of the inefficiency. How do you train your eye to see this? Well, one thing you can do, you got this straight from Michael's slides, all this straight from Michael's slides, is you go through and you mark out the bearish and bullish order flow on the monthly level. Squeeze the chart up. You're using hindsight to your benefit, right? Squeeze the chart up and highlight clear bearish moves, clear bullish moves when price is moving from external to internal liquidity. When it's clear that it's moving. Remember I told you this, the clear shifts would jump out at you. When they jump out at you. Mark out those areas, right? In this case, Michael marked out the bearish in red and the bullish times in blue. And then once you mark those out, mark out any important PD arrays on the monthly time frame, right? Price came down, it up here, it traded back up into a bearish order block. Okay, again, we got a bearish order block over here. Yes, it overshot it a little bit, but you got a bearish order block over there. So you're marking out any important PD arrays that you see on the monthly chart. Okay, and remember, take note of how price trades below the bodies or above the bodies of the candles when it's seeking liquidity, right? Bodies tell the story, wicks do the damage. And you can also study when it wicked below, where did it actually go? Where did it stop when we wick below? Where are these wicks really going? Move down to a weekly time frame. Now that you've got the whole monthly order flow, the monthly order flow marked out, now you can go back and study how did price move during that time, right? During this time, I was bearish because the monthly order flow was bearish. So I was looking on the weekly chart for opportunities to sell. I was looking for opportunities to sell on the weekly chart because I was bearish. And you go in and you annotate any important PD arrays or in the blue. Don't forget about the buying. I was looking for opportunities to buy on the weekly time frame because the monthly order flow had told me it was time to buy. Now, keep in mind, when you're on the lower time frame and you're waiting for the lower time frame to align with the higher time frame, the key indication is taking out a key high or low. In this case here, as price dropped down, you know, on the monthly time frame, this area down here is when price had dropped below the bodies of these monthly candles in this area here. So when we got this shift above this short-term high right here, that was an indication that price was ready to go back up and you could be looking to buy in that area now. If you are more advanced, you can take advantage of shorting during a bullish time frame, but you always want to try to trade on the side of the institutional order flow. Okay, and it's simple as that. Same thing. You go down to the daily time frame and if you're in a monthly bearish order flow, you look for opportunities to sell. If you're in a monthly bullish order flow, you look for opportunities to buy. And again, remembrance, taking note of the higher time frame PD arrays, because even if you don't have a key PD array on, let's say, the daily here, like there is a daily PD array here to trade off of when price comes back, you notice it has a confluence with a higher time frame PD array in the same place, which strengthens that buying opportunity for you there. So, institutional order flow, this is just a brief introduction to it. This is just getting your eyes used to seeing price move. Okay? Getting your eyes used to seeing the price move. Now, for your homework, let's go back through price. I want you to go back through price on the monthly time frame and highlight the bullish and bearish order flow the same way it was on the chart, right? We're going to use the ES continuous chart because we want to get a wide range of price. You're going to look at the monthly, then annotate key monthly PD arrays that price reacted to. And then once you do that, then you're going to repeat that. You're going to, now that you got your monthly time frame highlighted and you got your monthly PD arrays highlighted, you're going to drop down to a weekly chart inside the same highlighted area, and you're going to annotate key weekly price ranges where price made major moves from, right? Major moves from. Then you're going to go down to the daily price range and daily time frame and annotate key PD arrays that the daily chart made major moves from, and then you just study how did price move during bearish order flow, how did price move during bullish order flow, what PD arrays did it trigger off of, was it a certain day of the week that it triggered off of, and you can go as low on the time frames as you want to study the price. But this has been your introduction to the institutional order of the flow. And with that, that brings us to an end of another episode of Le Art of Reading Price Action. Again, my name is Timothy Lee Rogers Sr. I would like to thank you for tuning in to another episode. And until the next time I decide to get on Al Gore's internet and share my thoughts on this thing that we call price action, y'all be safe out in these trading streets, man. I'm gone. Yeah.